If you are in the process of buying your first home, you may have a lot of questions in your mind, like everyone else. One of them being, what are the different kind of mortgages? What is floating mortgage? What is fixed mortgage? What is principal and interest? What is interest only? So in this video, we're going to address all of that. So we're going to discuss the different kind of mortgages in this video. So stick around. Now, the first kind of mortgages are called fixed rate mortgages. Fixed rate mortgages are the mortgages where the interest rate remains same throughout the term that you are fixing it for. When you talk to your bank, you should always get multiple options for 6 months, for 12 months, 18 months, 2 years, 3 years, and you also should talk to them. Whether you're dealing with a bank or you're dealing with a mortgage broker, you should talk to them and others as well about how the market is behaving. If the market is going to increase, if the interest rates are intending to be increased over the next 1 year, it's sometimes better to fix for a slightly longer term. Whereas if the interest rates are going to come down, then it's probably better to just fix for a shorter term and then renew after the rates have come down. So always try and read about how the market is going to behave, and also talk to other homeowners who you may be friends with. Understand what they are doing with their home loans or mortgages, and sometimes it can be really helpful to yourself as well. One of the biggest benefit about fixed rate mortgages is that it gives you the predictability and the stability in your mortgage payments, since they remain same throughout the term that you have fixed it for. Now, the second kind of mortgages are called floating rate mortgages. Floating rate mortgages have an interest rate that fluctuate depending on the market conditions. Now, that means that the mortgage payments can vary from time to time, month to month, making it harder to budget and plan for the future. On the other hand, floating rate mortgages can be really beneficial. Now let's say if you've been talking to people and they're saying, or you've been reading about the market, you've been looking at it and you see that it's going to decrease over time. Floating rate mortgages can be beneficial if you're not fixed for a longer term, because you're not bound to pay the same amount of payments. Floating rate mortgages are beneficial if interest rates are low, as you can take advantages of lower rates and pay less interest over time. Fixed rate mortgages, as we spoke earlier, can be further split into two different variations. Now, the first variation is called interest-only mortgages. Interest-only mortgages allow you to pay only the interest for a certain period of time. Depending on the bank, it could be anywhere between 5 to 10 years. This can make your monthly mortgage payment lower for the interest-only period. However, you will not be making any payments towards the principal amount of your loan, which essentially means that after the end of your interest only period, your principal amount will still be the same. So you will have to still make your mortgage payments will actually increase from there. Now, let's take an example. Let's say you bought a house for $500,000. You put a 10% deposit towards it, which is $50,000. Now you have a mortgage of $450,000 on that house. Now let's say you fix the mortgage on an interest only for 2 years. Now for the first 2 years, you will only be paying the interest only on that mortgage, which means after the end of 2 years, let's say the total term of your mortgage was 30 years and you fix it for 2 years at interest only. After 2 years, your total term will be the remaining term from the total term will be 28 years. However, your total amount of the loan will still be standing at 450,000 because you didn't pay any of the principal amount in the first 2 years. Now you have to finish off your 450,000 now in 28 years instead of the total term of 30 years, which means you will be making higher payments for the remaining term of your loan. That is one of the biggest con if you're using the interest only mortgages. Having said that, So interest-only mortgages are also a popular choice for investors who like to keep property for a shorter amount of time and then flip it for a profit. So let's say if an investor wants to only keep a property for a couple of years or 3 years, then they generally tend to put it on interest only, pay lesser payments, and then flip it for a profit. And they don't care whether the principal stays same because they are not going to pay it off anyway. Now, the second kind of variation in fixed mortgages are principal and interest mortgages. Principal and interest mortgages are the options where you have to make payments towards your principal amount as well as your interest. So generally, your mortgage payment will be higher than the interest-only mortgage. Having said that, they are more popular for people who want to build equity in their house and want to also pay off their whole debt or mortgage in over a period of time. So in this case, part of your payment every month will be going towards your principal, and part of your payment every month will be going towards the interest. So over time, you can become mortgage free using principal and interest mortgages. So in the end, there are several different type of mortgage options available that you need to understand. I hope that this video helped you understand the differences between different type of mortgages, and it will help you make an informed decision when you go about making a decision on your own mortgage. Let me know if you have any questions in the comments below, and if you like the content, please subscribe to the video. Thank you.